In my experience, since I got into the future side of the business, I was a kid practically in the mid 1970s when gold was legalized. 75, I worked with Hutton, E.F. Hutton. I've seen a lot of little headlines that pop up here and there of some war incident. Somebody shoots somebody they didn't expect. Army versus army, and so suddenly there's anybody who buys those news headlines usually gets kicked in the gut for having done it. In other words, you might get a little spike in gold upside because of that, but it's ill-advised buying. Look at the most recent example, a big example. There was a big debate back in early 2022, late 21, whether Russia would invade Ukraine. The troops were amassed, but a lot of experts in the area said, no, it's not really just threatening, he's not really going to do it. And all of a sudden he did it, February 22nd. The thoughts crossed my mind that we could be, in fact, it was like a month or two ago, we on the first page of our report for just educational purposes, we put the Venezuelan stock market there, just the price chart, okay? It was lovely. What a rocket ship, upward curve, just like the money supply, off the page, and I said, what are we investing in the U.S. for? You could buy the Venezuelan market, and it's leaving the earth. Isn't it great? Well, of course, the money's degrading so rapidly that you could plot a loaf of bread in Venezuela and get the same chart. Okay, so the point being, could they actually go absolute ape and take us to a Venezuelan situation where everything goes up and it's absolutely meaningless, except gold, of course, would go up and hold its value, whereas the others would not quite keep. I don't think we're going to reach that point. I think, yes, we have a semi-Venezuelan situation globally anyway, where governments constantly print money, destroy the value of money decade by decade. Not quite the level of the Venezuelan situation or the Weimar Republic, So I don't think that's going to happen. We'll still have the boom bust, and the bust is happening. In fact, right now, even this teasing new high we made in the stock market, Nasdaq 100, S&P, where we went up, exploded off that April low, which, by the way, when it made that low, that was our bounce point. We predefined that the S&P would likely bounce from 4,800 and the Nasdaq 100 from 16,500. That's almost precisely where that low was. They turned up. We didn't argue they were going to make a new high, except they're going to have a good bounce. Instead, they went up and made the new high.
The Venezuelan tale isn't isolated. It reflects a global pattern of monetary dilution. Across many economies, money supplies steadily expand, eroding purchasing power decade after decade. In this environment, only real assets like gold tend to preserve value. Unlike episodic shocks, wars, or crises, this is a structural erosion. Money degrades, and nominal prices climb. Tracking monetary aggregates, like M2 over 10-year spans, offers insight into this relentless trend. It's a quiet erosion, but undeniable, and gold remains, above all, the refuge against it.
Again, a marginal new high. But the speed of that recovery was very rapid until they got to the new high level, challenged the old high, which was late 2024, early 2025 levels. And then when they broke through it, they didn't explode. They crawled. If you look at the week-to-week action in the indexes since that April low, there was a dramatic bounce. But once they got and, quote, broke out over the old high, it was creepy crawly. It's really bizarre. It's like, what's going on here? Well, there's a lot of buying, but it's just not having the impact. There was a book written in 1958 that I've mentioned in our reports to our subscribers. Edwards and McGee. Title was Technical Analysis of Stock Trends. Okay, it's a 400-page monster book with fine print, and it deals with chart patterns that they discovered, developed, and defined throughout the book. And one of the patterns, which is long forgotten by most technicians, price technicians, it's called the broadening top. The broadening top is a very deceptive topping pattern that teases you into being comfortable. What it is you make a high, then you have a sharp drop. You turn around, make a higher high, point number 2. then have another drop that actually takes out that prior drop. So a lower low, you get a higher high, lower low, you get a widening pattern, and then it's the third upturn that makes yet again a third new high. It's that one you got to watch, because if it's a broadening top pattern, which I argue we are highly likely in, because momentum argues this new high is no good, it's when you turn down from that third new high in this widening pattern, not a narrowing triangle like everybody likes to plot, but one that's absolutely the opposite. If when you turn down from that new high, like we're doing, let's say right now, if you turn down from here and you get back below the highs we saw early this year in the S&P, which is only like 350 or so points below where we're trading right now, so 5% or so, 5 or 6%. Something's wrong. In other words, that new high was yet another teaser, in which case this broadening top pattern that they defined is starting to unfold. And usually they're disastrous. Momentum of the market, long-term momentum, already argues that you're in a topping process. Because while price has just nudged a new high, momentum's laughing at it. Momentum is, what? New high? The momentum's already broken, in other words. So I'm highly doubtful that this will sustain upside price. And when it rolls over, you're going to get the down. Now, the issue of crash, you mentioned that.
In spring 2025, U.S. equity markets performed a startling recovery from lows established in April, S&P 4,800, Nasdaq 100, 16,500, nearly matching analysts' projections. Yet after breaching previous highs, the rally's momentum wavered, transforming into a sluggish crawl across weekly charts. Notably, a bearish death cross emerged in April, 50-day moving averages slipping under 200-day averages, a classic signal of weakening bullish sentiment. It's a reminder that fast recoveries can falter, leaving markets prone to reversal instead of breakout.
I'm not going to argue that there's ever going to be a crash. You could still have a savage bear market, a wipeout bear market without a crash. Yes, 1929 began with the crash, and then you had a 50% rally back to the high, and then you went down. The real down to the 1932 low was incremental. There was no crash. It was just grinding bloodletting, for 2.5 years, like an 80% drop. .com high. If you go back and look at the S&P or Nasdaq, then there really never was a crash event, 2000 to 2002. It was just a bloody decline. Nasdaq went down 82%. S&P went down 50. And yet there never was what you can define as a crash being like 30 to 35% in 2 weeks. Okay, it just didn't happen. So I'm not sure that'll happen. There is one arena, I think, that you could get a crash. And it is one that we're watching for ambush effect, because it's now linked to the stock market, and that's Bitcoin. If you look at a Bitcoin monthly price chart and then punch up a monthly price chart of the Nasdaq 100 and lay them on top of each other, put one above the other and look at them, almost month by month, they're the same action for the last, let's say, 3 years. Prior to that, that wasn't the case. But suddenly now Bitcoin behaves like the bubble market of the Nasdaq 100. Excitement, frothy, pull back same time, congestion at the same time, punch out to a marginal new high again recently like Nasdaq did, so did Bitcoin.
A seldom invoked but potent chart formation, the broadening top or megaphone pattern, describes this very behavior, higher highs and lower lows forming diverging trend lines. It typically appears near market peaks, reflecting volatility and investor uncertainty. Historically, it signals upcoming reversals as technical momentum diverges from price consensus. Markets may tease with a third new high within the pattern before rolling over. Recognizing this signal early and managing risk can help guard against the most turbulent unwinds.
There are levels on Bitcoin. And nobody's watching for this. I'm arguing that likely that when you turn down in Bitcoin, you're going to get a crash event, not just a bear trend. In other words, you're going to get an ambush, an emotional ambush. And because Bitcoin is so now linked, not just technically, but financially, to so many big corporations, and underlying so many assumptions that are out there, not just among speculators, but among big companies that have made commitments, that when it goes, it could go so rapidly that it's a crash type event. Because, why? When you look at Bitcoin's quarterly momentum, and what I mean by that is you take the monthly bars of Bitcoin and you oscillate them versus the 3-quarter moving average, which is almost like a 200-day average. And you create an oscillator. You have the exact same pattern that you had prior to the 1987 stock market crash. In fact, if I took the labels off of them, you couldn't tell the difference. Now, we're not there. We're not down to the trigger levels. But starting in about 6 weeks, when we move into the new quarter, right now, Bitcoin, as we're talking, has dropped about $10,000 from the high we just made to about 115,000. I would caution anybody in Bitcoin, if you get back below 110,000, which is a distribution zone we saw late last year, they're selling at 110. Then early this year, selling. And then finally it burst through, same time as Nasdaq burst through its old high. You get back below the 110,000, it says that breakout was a trap. But you get down into the 103 to 105,000 zone next quarter, meaning in a handful of weeks, the numbers will adjust. You're at the structure that the 1987 S&P dropped down to and precipitated its crash, a momentum structure, not evident on price.
In recent years, Bitcoin's price behavior started echoing major tech indices. Its 30-day correlation with the Nasdaq Composite climbed from Rue 0.62 earlier in the year to 0.74 by mid-2025. Analysts now argue it behaves not as a standalone asset, but like a digital tech stock, subject to the same speculative swings and macro forces. As of August 26th, Bitcoin had fallen about 12% from its all-time high, dropping to roughly 108,700. Data highlights technical warning signs, including RSI divergence, raising concerns that its recent peak may be a bull trap.
When I see that kind of momentum structure that is so hyper clear, it tells me, this market could be in big trouble, sudden trouble. That would be the kind of event that tends to happen in stock bear markets where suddenly it's in an area you don't expect. Everybody's looking at AI, for example. Yeah, AI is going to lead the way down probably when you go because it was the leader on the way up. The leaders usually have the biggest drops. But that's where everybody's looking. Nobody's looking at commercial real estate, which is a very vulnerable area technically and fundamentally. Nobody's looking at Bitcoin with that concept in mind that I just explained, that we have a technical argument for. And another arena to watch in that regard also is the T-bond market in terms of creating a panic event. So anyway, all these things are percolating off to the side here. And you can bet that when they occur, and I think they're going to occur, that's going to be what? A panic button for the central bank here and elsewhere, also for the central government. Monetary excess will be full throttle again. What's the chief beneficiary? In my experience, since I got into the future side of the business, I was a kid practically in the mid-1970s when gold was legalized. 75, I worked with Hutton, E.F. Hutton. I've seen a lot of little headlines that pop up here and there of some war incident. Somebody shoots somebody they didn't expect, army versus army. And so, suddenly there's anybody who buys those news headlines usually gets kicked in the gut for having done it. In other words, you might get a little spike in gold upside because of that, but it's ill-advised buying. Look at, for the most recent example, a big example. There was a big debate back in early 2022, late 21, whether Russia would invade Ukraine. The troops were amassed, but a lot of experts in the area said, no, it's not really just threatening. He's not really going to do it. And all of a sudden he did it, February 22nd.
Whether gold, equities, or crypto, each carries unique dynamics, yet they share common vulnerability. A bear market need not start with a crash. Historical declines, like post-2000 tech crash or 1929-32 downturn, played out as grinding sell-offs, not sudden collapses. Still, Bitcoin presents unique ambush risk. High sentiment, financial entanglements, and fragile technical structure could trigger an abrupt crash. Markets, too, can mask weakness in subtle patterns. Death crosses divergence or broadening tops until it's too late. Vigilance, context, and diversified perspective remain our best defense.
If you shorted gold in the few weeks after that event, when it was near a high, you nailed it, and you made about we were up in the above 2,000 again in price. It dropped to 1620 by summer fall of 2022. You dropped 20% in gold after that war event started. So when the war started, commodities and gold both peaked within days or a few weeks of that event, after having had a major move well prior to the event, which was, again, not really expected. So if you bought war news then, you got killed. No, ultimately, gold reasserted itself. But I find war events are not the driver of gold. You want to know what the driver of gold is. Get an M2 chart or a money supply chart from any country, Western world. Put it on your screen. Do the math of every 10 years, what's the rate of growth in the money units, the supply of money, and therefore the degradation of money. When your granddad built a house, it cost him $4,500. Now it costs $450,000. Okay, so is that because houses are? No, it's a degradation of the money unit. Gold maintains its value versus the ongoing degradation in the money units, period. And until that ever ends and we go to a gold-backed money here, there, and globally finally, that's going to continue. It holds its value. You go back like 25 years ago, summer, 25 years ago, so exactly 25 years, in mid-2000, gold's gone up more than 11-fold. S&P 500's gone up 3.5-fold, which has done better at preserving your money. Okay, it's the degradation of the money unit ongoing. Yes, there are times when gold will inhale and exhale, but ultimately the curve, it will maintain its value versus the degradation of the money unit. Not because of this war or that. Yeah, sometimes wars help stimulate money growth because they print money, but governments don't really need that excuse. I mean, you go back to the mid-50s, well after World War II, and you'll see this upward curve in the money supply, regardless of a war here or there. Okay? So anyway, that's my argument. If you're in gold, don't make that mistake that it is driven by uncertainty. No, it's driven by certainty. Certainty that the money units are constantly degrading, period.